The Bogleheads Guide to Investing by Taylor Larimore, Mel Lindauer, and Michael LeBoeuf. Introduction. Have you ever wondered if it's possible to become a millionaire on a regular, everyday salary? Not by winning the lottery, or inheriting a fortune, or getting lucky on some hot stock tip, but just by quietly, consistently doing something simple over a long period of time. Let me tell you a story. A few years ago, a letter arrived at the headquarters of a very unique investment company. The man who wrote it said he had been investing with them since the mid-1970s. Over that time, his portfolio had grown to $1.25 million. Now, here's the part that should make you lean in a little closer. Throughout his entire life, this man never earned more than $25,000 a year. How is that possible? Was he a secret stock market wizard? Did he have some genius advisor whispering in his ear? The answer is no. He was an ordinary person who stumbled upon an extraordinary and profoundly simple philosophy of building wealth. He became what is now known as a Boglehead. The book we're exploring today, The Bogleheads Guide to Investing, is the playbook for that philosophy. It was written not by Wall Street gurus in slick suits, but by three retired, self-educated investors named Taylor Larimore, Mel Lindauer, and Michael LeBoeuf, who learned the hard lessons of the market so that you don't have to. They are part of a massive, grassroots movement of millions of everyday investors who follow the teachings of one of the financial world's quietest revolutionaries, John C. Bogle, the founder of the Vanguard Group. This isn't a get-rich-quick scheme. In fact, it's the exact opposite. It's a get-rich-slow, get-rich-for-sure philosophy. By the time we're done today, I promise you will have a clear, simple, and powerful blueprint for building your own financial freedom. You will understand why most of what you hear on television and read online about investing is designed to make other people rich, not you. And you will learn the one secret that separates the financially independent from everyone else. It's a secret so simple, you might just dismiss it at first. But I urge you to listen closely, because it's the key that unlocked that million-dollar future for a man earning $25,000 a year, and it's the same key that is waiting for you to turn it. Book summary. Let's begin with a simple observation about the world. Every year, 100 young, bright-eyed Americans start their careers at age 25. By the time they reach 65, what do you think has happened to them? The statistics have been remarkably consistent over time. 1 will be rich. 4 will be financially independent, able to live comfortably without working. But the other 95, they will reach retirement age unable to support the lifestyle they've grown accustomed to, dependent on government programs just to get by. We live in the richest country in the history of the world, yet only 5% of us achieve financial freedom. Why? The authors of the Bogleheads Guide argue that the answer isn't about how much money you make. It's about the financial lifestyle you choose to live. They break it down into 3 simple categories. See if you recognize anyone you know. Or maybe even yourself. First, there are the borrowers. Their motto is, "Live for today, forget tomorrow." Their life is built on a house of credit cards. They have the newest car, the latest fashions, the biggest house, all financed by enormous debt. To them, credit cards are like free money. Just pay the tiny minimum balance each month and the party never has to end. They see their home value go up and immediately take out a home equity loan to fund a luxury cruise. Their financial future isn't just standing still, it's going backward, building what the authors call negative wealth. They are 1 job loss, 1 illness, 1 unexpected event away from total collapse. Next up, we have the consumers. This is where most people live. Their mindset isn't built on credit cards, but on their paycheck. They look at their take-home pay, and their main goal is to spend all of it. When they want to buy something big, a car, a new TV, the magic question they ask is, Can we afford the monthly payments? They never stop to consider how much interest they're paying or how long they'll be in debt. Their employer might offer a 401k plan with free matching money, but they pass it up. They'd like to save, but there's always something they need right now. The authors put it beautifully: the consumers believe they own their lifestyle, but in reality, they are just renting it. Finally, there's a third, much smaller group: the keepers. The keepers have a completely different mindset. While others are focused on their income, the keepers are focused on their net worth. Their motto is, "It's not how much you make, it's how much you keep." They might not earn any more than the borrowers or the consumers, but their financial future is infinitely brighter. What do they do differently? It's one simple, powerful habit. The very first thing they do with every single paycheck, before paying bills, before buying groceries, before anything else, is make a payment to their future self. They save and invest at least 10% off the top. They eagerly take advantage of any matching programs at work. They use credit cards for convenience but pay the balance in full every single month. They don't live lives of deprivation. They have nice things, they take vacations, but they do it after they paid their future selves first. They have a plan. This is the first and most fundamental lesson of the Boglehead philosophy. Before you can even think about investing, you must choose to be a keeper. You must graduate from a paycheck mentality to a net worth mentality. So, the book gives us 3 concrete steps to take before we even buy our first stock or mutual fund. First, calculate your net worth. This is your financial report card. It's simple. Add up everything you own, cash, your car, investments, and then subtract everything you owe, credit card debt, loans, mortgages. The number you're left with is your net worth. It's the true measure of your financial health. Make it a habit to calculate this once a year. It's the starting point on your map to financial freedom. Second, pay off all your high-interest debt, especially credit card debt. The authors are crystal clear about this. Paying off a credit card with an 18% interest rate is like earning a guaranteed, risk-free, tax-free 18% return on your money. You will never find a better, safer investment than that. Every dollar you carry in high-interest debt is a dollar that's making a bank rich instead of making you rich. Get off the merry-go-round. And third, establish an emergency fund. Life is unpredictable. Job loss, illness, or disaster can strike when you least expect it. You need a cash cushion, a separate, safe, and easily accessible account with 3 to 6 months of living expenses. This fund isn't for investing, it's for sleeping well at night. It's the firewall that protects your long-term investments from life's short-term emergencies. Once you've done these 3 things, you've built the foundation. You're ready to become an investor. And this is where the magic begins. Have you ever heard of the Rule of 72? It's a simple mental shortcut that Albert Einstein supposedly called the greatest mathematical discovery of all time. To figure out how many years it will take for your money to double, you just divide the number 72 by your annual rate of return. So, if your investment earns 8% a year, your money will double every 9 years. If it earns 12% a year, it doubles every 6 years. That might not sound like a big deal at first. But watch what happens. Every time it doubles, it's not just doubling your original investment. It's doubling the new, larger amount. It becomes 2, then 4, then 8, then 16, then 32 times what you started with. If you start with a single penny and double it every day, by day 30, you'd have over $5 million. That is the power of compound interest. And the single most important ingredient to making it work for you is time. The authors illustrate this with a powerful example. Let's imagine 2 people. Eric Early starts investing at age 25. He puts $4,000 a year into his retirement account for just 10 years, and then he stops. His total investment is $40,000. His friend, Larry lately, doesn't start until age 35. But he's more diligent. He invests $4,000 every single year for 30 years, right up until retirement. His total investment is $120,000, 3 times as much as Eric. Now, who do you think ends up with more money at age 65? Even though Eric invested for only 10 years and stopped, his money had an extra decade to grow and compound. At age 65, assuming an 8% return, Eric's $40,000 turns into nearly $630,000. Larry, who invested 3 times as much money, ends up with only about $489,000. Eric started 10 years earlier and ended up with nearly 30% more money, despite investing 1/3 of the amount. If you are young, you are standing on a mountain of gold. And that gold is time. The biggest investment mistake you can make is not starting. The book makes this clear. Deciding how much to save is the most important financial decision you will ever make, because you can't invest what you don't save. So now that we understand the why question mark the power of starting early, let's talk about the what. What exactly are we buying when we invest? The book breaks down the 2 main building blocks of the financial world: stocks and bonds. Imagine a big, successful pizza company. When you buy a stock, you are buying a tiny slice of that company. You are now a part owner. If the company does well, makes a lot of profit, and grows, the value of your slice goes up. You make money. If the company struggles, the value of your slice can go down. You can lose money. It's a higher risk, higher reward game. Now, imagine that same pizza company wants to expand and build a new factory, but it doesn't want to sell more slices of ownership. Instead, it decides to borrow money. When you buy a bond, you are essentially lending your money to that company, or to a government. In return, they promise to pay you back your original loan on a specific date in the future. That's the maturity date, and along the way, they pay you regular interest payments. It's generally a lower risk, lower reward game compared to stocks. Bonds are for stability. The authors explain that there are many types of bonds, but for most of us, the safest are those issued by the U.S. government, known as Treasury bonds, because they're backed by the full faith and credit of the United States. Now, here's a crucial concept. There's a silent thief that is always trying to steal the value of your money. That thief is inflation. Inflation means that $1 tomorrow will buy less than $1 today. An inflation rate of just 3% means that in 24 years, your money will lose half of its purchasing power. To combat this, the U.S. Treasury created special bonds called TIPs, Treasury Inflation Protected Securities, and I-bonds. The value of these bonds automatically adjusts upward with inflation, guaranteeing that your investment keeps its buying power over time. They are one of the safest investments on the planet for preserving your wealth. So you can buy individual stocks and individual bonds. But for the average person, this is difficult and risky. If you put all your money into one company's stock, and that company goes bankrupt, think of Enron, you could lose everything. To be safe, you need to diversify. You need to spread your money across many different companies and industries. But buying dozens of individual stocks can be expensive and complicated. This is where the Bogleheads' most important tool comes into play: the mutual fund. A mutual fund is simply a big pot of money where thousands of investors pool their resources together. A professional manager then takes that giant pot of money and buys hundreds, or even thousands, of different stocks or bonds. When you buy a share of a mutual fund, you instantly own a tiny piece of all those different investments. It's instant diversification. Now, there are 2 main styles of managing a mutual fund. There's active management, where a manager and their team of analysts spend their days trying to be brilliant. They try to pick the winning stocks and avoid the losing ones, timing the market to buy low and sell high. They are trying to beat the market. For this service, they charge higher fees. Then there is passive management, also known as indexing. An index fund manager doesn't try to be a hero. They have one simple job: to replicate the performance of a specific market index, like the S&P 500, which is a collection of 500 of the largest U.S. companies. If a company is in the index, the fund buys it. If it's not, they don't. There's no stock picking, no market timing, no trying to outsmart anyone. The goal is not to beat the market. The goal is to be the market. Because this is so much simpler and can be done largely by computer, the fees for index funds are incredibly low. This brings us to the very heart of the Boglehead philosophy, and it's a truth so powerful and so counterintuitive that the entire Wall Street marketing machine spends billions of dollars a year trying to convince you it isn't true. The simple truth is this: over long periods of time, the vast majority of actively managed funds, run by the so-called experts, fail to beat the simple, low-cost index fund. Studies show that as many as 80% to 90% of active funds underperform their index benchmark over 20-year periods. How is this possible? Why do the average index funds consistently beat the experts? The answer comes down to one word: costs. The authors call this the relentless rules of humble arithmetic. Imagine two investors. Both are invested in the same market, which earns a 10% return for the year. The active investor pays a 2% fee to their fund manager. The index investor pays a 0.1% fee. At the end of the year, the active investor has earned 8%, while the index investor has earned 9.9%. That small difference, compounded year after year, becomes a Grand Canyon-sized gap in wealth over a lifetime. The high fees, sales commissions, and hidden trading costs of active funds act like a constant, powerful headwind, while the low costs of index funds give you a steady tailwind. As John Bogle himself said, the shortest route to top quartile performance is to be in the bottom quartile of expenses. In the world of investing, you don't get what you pay for. You get what you don't pay for. So, the Boglehead strategy is to make low-cost index funds the core, or even all, of your portfolio. It's a strategy that takes almost no time, no skill, and yet outperforms about 80% of all professional investors. But which funds should you buy? And how much should you put in stocks versus bonds? This leads us to what the book calls the single most fundamental decision of investing: asset allocation. Asset allocation is simply deciding how to divide your investments among different asset classes, primarily stocks, bonds, and cash. Why is this so important? Because stocks and bonds don't always move in the same direction. When stocks are soaring, bonds might be plodding along. But when stocks are crashing, high-quality bonds often hold their value or even go up, acting as a crucial shock absorber for your portfolio. A famous study found that over 90% of a portfolio's return variability is determined by its asset allocation, not by picking the right stocks or timing the market. So how do you decide your allocation? The book offers a simple starting point, a rough rule of thumb from John Bogle himself: own your age in bonds. So, if you're 20 years old, you might have 20% in bonds and 80% in stocks. If you're 60, you'd have 60% in bonds and 40% in stocks. As you get older, you gradually become more conservative, shifting from growth stocks to preservation bonds. This isn't a rigid rule, but a guide. The more risk you're willing to take, the more you can lean toward stocks. The less you can stomach watching your portfolio drop, the more you should lean towards bonds. The book includes a simple questionnaire to help you determine your own risk tolerance. The goal is to create a portfolio that lets you sleep at night, even during a scary market crash. This is what the authors call the sleep test. So, a simple, powerful Boglehead portfolio for a young person might look like this. 80% in a total stock market index fund. This one fund holds thousands of U.S. stocks, big and small, giving you ownership in nearly the entire U.S. economy. 20% in a total bond market index fund. This one fund holds thousands of high-quality U.S. bonds, providing stability. Many Bogleheads also add a total international stock index fund to capture growth from around the world, suggesting an allocation of about 20% of your stock portion to international markets. And that's it. A three-fund portfolio. Simple, diversified, low-cost, and powerful. Once you have your plan, the work is mostly done. But there are a few final crucial principles for managing your investments over the long haul. First, you must tune out the noise. The financial media, the TV shows, the magazines, the websites, are not in the business of making you a better investor. They are in the business of attracting an audience to sell advertising. They do this by creating excitement, fear, and a sense of urgency. They parade experts who confidently predict where the market is headed next, even though study after study has shown that nobody can consistently predict the market's short-term movements. They tout the hot funds of the moment, encouraging you to chase past performance. But the Bogleheads know that performance chasing is a loser's game. The fund that was number one last year is very unlikely to be number one next year. In fact, often last year's winners become next year's losers. As the saying goes, past performance is no guarantee of future results. The authors are blunt, believe it. The second principle is to master your emotions. The two great drivers of the market are greed and fear. When the market is soaring, greed takes over. People get overconfident, pile into risky investments, and follow the herd, buying high. When the market crashes, fear takes over. People panic and sell everything, locking in their losses. The average investor consistently underperforms the market precisely because they let their emotions drive their decisions. The successful investor has a plan and sticks to it, regardless of the noise and the emotional roller coaster of the market. This leads to the final, and most important, mantra of the Boglehead philosophy. Stay the course. Once you have your simple, low-cost, diversified plan, the most important thing you can do is nothing. Let your automatic investments do their work. Rebalance your portfolio perhaps once a year, that is, sell a bit of what is done well and buy a bit of what is done poorly to get back to your original asset allocation. But otherwise, ignore the headlines. Ignore the gurus. Ignore the urge to do something. As John Bogle has said 1,000 times, stay the course. It is the most important single piece of investment wisdom I can give to you. Because building wealth isn't about excitement. It's about discipline. It's not about being a genius. It's about being patient. It's about understanding a few simple, powerful truths and having the courage to stick with them for a lifetime, allowing the magic of compounding to do its quiet, wonderful work. Commentary. When you really boil it down, the Bogleheads Guide to Investing is built on a foundation that feels almost revolutionary in today's world of complex financial products and non-stop market noise. The core idea is one of radical simplicity and profound humility. The book's most powerful lesson, I think, is that in the world of investing, your greatest enemy is very often yourself. It's your own emotions, your greed when the market is hot, your fear when it's crashing. It's your overconfidence, the belief that you, or someone you hire, can outsmart the collective wisdom of millions of investors around the world. And it's your impatience, the desire for quick results in a game that rewards the long view. The Boglehead philosophy is an antidote to all of that. It's a system designed to protect you from your own worst instincts. By automating your savings, investing in the whole market through index funds, and committing to stay the course, you are taking your ego and your emotions out of the driver's seat. You're admitting that you don't know where the market is going tomorrow, and that's perfectly okay, because you don't need to. Your success isn't dependent on prediction, it's dependent on participation. What I find so empowering about this message, especially for someone just starting out, is that it completely democratizes the process of building wealth. It tells you that you don't need a fancy degree, you don't need to be born into money, and you certainly don't need to pay a high-priced advisor to hold your hand. The tools for success are available to everyone, and they are surprisingly simple and inexpensive. It's a philosophy of empowerment. It's about taking control of your financial destiny, not by trying to be a market genius, but by being a disciplined, intelligent consumer of financial products. It teaches you to focus relentlessly on the very few things you can actually control: how much you save, the costs you pay, the taxes you incur, and your own behavior. If you get those 4 things right, the market will take care of the rest. So, if you were to take just a few simple actions after listening to this today, what should they be? First, embrace the idea of paying yourself first. Right now, go to your bank's website and set up an automatic transfer from your checking to your savings account for the day after you get paid. It doesn't have to be a huge amount. Start with just $25 or $50. The goal is to build the habit. Make saving automatic, so it happens without you even thinking about it. Second, open a Roth IRA. This is a retirement account where your money grows completely tax-free. At a young age, this is one of the most powerful wealth-building tools you will ever have. Inside that Roth IRA, you can start by investing in a single, low-cost target date fund or a total stock market index fund. And third, once you've set that up, make a promise to yourself. Promise that you will ignore the noise. You won't check it every day. You won't sell it if the market crashes. You will simply let it be, and you will continue to feed it, month after month, year after year. That's it. That's the start. You will be laying the foundation for a future of financial freedom, not with complexity and stress, but with simplicity and peace of mind. That was a summary of the Bogleheads Guide to Investing by Taylor Larimore, Mel Lindauer, and Michael LaBeouf. We've journeyed through the core principles today, but I'll be honest with you, a summary is like looking at a photograph of the Grand Canyon. It can show you the landscape, but it can never capture the feeling of standing on the edge, seeing the scale and the beauty for yourself. The real magic happens when you read the book. It's in the quiet moments, when a particular story or a simple phrase connects with you in a way you didn't expect. This summary is designed to help you decide if this book is worth your time. If anything we've talked about today has resonated with you, I truly encourage you to grab a copy. Reading it isn't just learning, it's an experience that can genuinely change the way you see your financial life. The link to the book is in the description. Also, if you found this summary valuable and it sparked a new idea or gave you a bit of clarity, please do me a small favor and hit that subscribe button. That way, you won't miss our next journey into another life-changing book. Let's keep learning and growing together.